Is the Bank of Canada's latest interest rate cut the key to unlocking growth in the multifamily real estate market? With a 175 basis point reduction from its peak, industry professionals are buzzing with optimism. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. The Bank of Canada's recent decision to cut its policy rate by 50 basis points to 3.25% has been met with applause from the real estate industry. This marks the fifth rate cut of the year, as the central bank attempts to boost an economy facing challenges such as lower than expected economic growth and potential tariffs on Canadian exports to the United States. According to CoStar News, the central bank's decision comes amid a backdrop of heightened economic uncertainty, with rising unemployment and a consumer sector dealing with high levels of debt. Jane Renwick, Executive Vice President of Savoy Developments, expressed enthusiasm for the rate cut, noting its potential to make mortgage rates more digestible for consumers. She highlighted that in a low-interest rate environment, real estate products tend to sell more easily. However, she also emphasized the need for further cuts in 2025 to truly spur the market, as high carrying costs remain a concern for consumers. From a multifamily perspective, the Bank of Canada's move is seen as a potential catalyst for increased market activity. The rental market, as reported by rentals.ca, saw asking rents for all residential property types decline to a 15-month low, indicating a potential easing in the affordability crisis. This could be a silver lining for multifamily investors, as lower interest rates might encourage more investment in rental properties. Luke Simmerda, Director of Research for Marcus & Millichap in Canada, noted that the ongoing monetary easing could serve as a tailwind for commercial real estate construction in the coming year. While bond markets have largely priced in these movements, further monetary easing and slower economic growth could pull down longer-term yields, potentially stabilizing the market and boosting investor confidence. The Bank of Canada's new approach, moving from inflation control to economic stimulation, is already impacting market sentiment. Royal LePage forecasts a return to long-term property price appreciation norms by late 2025, with the aggregate price of homes in Canada expected to increase by 6% year over year. This shift is seen as a positive development for the multifamily real estate market, as it could lead to increased transaction activity and a more vibrant market landscape. As we turn our focus on Saskatchewan, it's clear that the province is experiencing a notable surge in its commercial real estate market. According to ranks.ca, this growth is largely driven by population increases, business investments, and a rising demand for high-value resources like energy, potash, uranium, and agricultural products. These factors are bolstering the demand across industrial, retail, office, and multifamily properties, setting the stage for continued growth in the region. Michael Cooper, the founder and chief responsible officer of Dream Group of Companies, highlighted Saskatchewan's diverse resources at the recent Saskatchewan Real Estate Forum. He emphasized that these resources do not require substantial federal input for development, giving Saskatchewan an edge over provinces like Alberta. Cooper noted, "The GDP per capita is good, and it's growing. The cost of living is quite reasonable, and we just think there's more opportunity for Saskatchewan to benefit from the federal government initiatives on major projects." Mitch Molnar, Chief Executive Officer of MDL Real Estate Income Fund, echoed Cooper's sentiments, pointing out the vital role of food, fuel, and fertilizer in the provincial economy. These sectors are not only foundational to Saskatchewan, but also present steady and productive growth opportunities despite challenges such as tariffs. Barry Stewart, partner and broker with ICR Commercial Real Estate, has observed a reduction in vacancy across various sectors, with Saskatoon having one of the lowest retail vacancy rates in Canada. He attributes this to Saskatchewan's unique market dynamics, which have remained resilient even through challenging times. Prabha Ramaswamy, Chief Executive Officer of the Saskatchewan Chamber of Commerce, provided further insights into the province's economic landscape. Saskatchewan leads in private capital investment and housing start growth, ranks high globally for mining investment attractiveness, and boasts the lowest unemployment rate among Canadian provinces. These factors, combined with a strong resource base and substantial provincial capital infrastructure spending, underscore the Saskatchewan advantage. Eric Anderson, Executive Director of the Saskatchewan Industrial and Mining Suppliers Association, emphasized the long-term value of Saskatchewan's resource production. This aligns with James Ha, President of Boardwalk REIT, who regards Saskatchewan as a top market in their portfolio due to its affordability and resource wealth. Faruk Suvankalov, Regional Director of Economics at the Bank of Canada's Calgary Regional Office, noted Saskatchewan's resilience to trade tensions, with strong growth supported by mining and construction sectors. The province's export-driven economy, particularly in food, fuel, and fertilizer, continues to thrive. In summary, Saskatchewan's commercial real estate market is thriving, driven by its resource-rich environment and robust economic fundamentals. These factors are not only fostering growth within the province, but also attracting national and international investors. It's an exciting time for Saskatchewan, and the outlook remains positive. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.